Welcome back to the show. Today I'll be talking about a stock that I just bought, what I'm planning to do with my cash, as well as some questions left in the comment section below. So let's talk about the stock that I just bought, and it's somewhere here in this list of stocks. And this company is none other than PoolCorp. So PoolCorp is a company that is down 11% year to date. It's currently trading at a 27 times earnings with a dividend yield of around 1.7%. So what exactly does PoolCorp do? PoolCorp sells everything required to construct your pools, to remodel your pools, and to maintain your pools. And for this company, they basically have around 60% of their revenues coming from non-discretionary portions. Around 22% is somewhat discretionary when people need to remodel and renovate their pools, and only 17% is related to the construction of new pools. So the US housing market is extremely weak right now. It has been weakening since 2020 when the Fed lowered interest rate to around 0%, and currently we're seeing the effects of it. We're seeing the effects of your high interest rates. And in the US as well, the mortgage rate there, the 30-year mortgage rate is now at around 7%. It's incredibly high. So it's been ramping up since around 2022. In 2022, it was around 3%. Currently now it's double of that, it's around 7%. And what happens when your mortgage rate is high is that less people will buy houses. And when less people buy houses, it will lead to less pools being built. And then the other headwind for the stock as well is the chlorine prices. So chlorine prices, they spiked up post-COVID, and then they've been on this gradual slowdown ever since then. So what happens when your chlorine prices drop is that PoolCorp's profit margins will drop over time. Because for PoolCorp, most of their costs are fixed, so it's just human capital costs, as well as some costs for the supplies. But if your chlorine prices start to drop, then it will eat into their margins, which is why their profit margins have been declining over the past few years. And for PoolCorp, it is undergoing some form of normalization post-COVID. So post-COVID itself, the government gave out a lot of stimulus checks. Coupled that with a low interest rate, that led to the boom in PoolCorp's earnings itself, because more people wanted to buy pools with all the stimulus checks. And if you were to look at the pool interest over time, this is from Google Trends, it actually peaked at the same time as well, around 2022 when we saw that peak. And currently now we're still in this downtrend in terms of the pool market. And for PoolCorp, they also have competition from SRS Distribution. So SRS Distribution, they operate another pool company, which is your Heritage Pool. And for Heritage Pool, they are competitors to PoolCorp in the same space. So let's talk about the PoolCorp versus Heritage Pool business model first, the business competition. So PoolCorp has a larger scale. It has 400 locations versus Heritage, which is around 150. PoolCorp has a wider range of SKUs. So what happens when you have a wider range of SKUs? SKUs meaning the wider range of product, is that when people come into PoolCorp and then they start finding their supplies, they'll be able to buy everything at one go. And the idea is that PoolCorp is sort of like a one-stop shop as well. So when you have more SKUs, when you have more varieties, then more people will come into the store because it's more convenient to buy everything at one shot. And for PoolCorp, they also offer seller financing through internal credit. So there's less risk for the company as well because they don't have to rely on external credit. As for Heritage Pool, they still rely on some external secondary platform for this seller financing portion. And for PoolCorp, they have the greater delivery, they have faster delivery, they have greater relationships with their long-term suppliers as well as their long-term customers as well. So in the US itself, the housing market is weak right now, but that could start turning with the interest rates dropping. So when your rate starts to drop, more houses will be built, and when more houses are built, it leads to more pools as well. The chlorine prices are also normalizing from the COVID boom, so that could take some time, but I prefer buying on a downtrend rather than buying on an uptrend. And for PoolCorp, they also have great leverage over the suppliers. So for example, PoolCorp gets a lot of their pumps from this company called Pentair, and this company, Pentair, has around 20% of the total revenue coming from PoolCorp. So this gives PoolCorp negotiating power when it comes to the pricing itself, because Pentair, if they increase the prices by too much, they could risk losing PoolCorp as a customer. For PoolCorp, because they're just a distribution network, they not only have the ability to suppress prices from suppliers, they can also pass on the inflated prices to consumers itself. They don't have to bear the cost themselves. So for PoolCorp, the metrics are quite incredible as well. In the recent years, we've seen a downturn because of the weaker housing market. So for example, PoolCorp's profit margins have dropped from around 12% to currently now around 7%. The ROIC has also dropped from around 23% down till now around 14%. So this company is undergoing some form of sector downturn, and that's why you're seeing Warren Buffett buying into it as well. And for PoolCorp, the growth rate before the COVID boom was actually around 11%. So if we can see an 11% growth for this company at this price, I think it is more than reasonable. They were growing at a decent pace before COVID, before the boom that they had in 2020 as well. So for PoolCorp, the stock price is also quite depressed right now. So the stock price is actually down around 50% from all-time highs already. And it's rare to see a monopoly like this being down around 50%. They hold around a 50 to 60% market share in the pool space in the US itself. And for PoolCorp, the earnings are likely suppressed right now. So So their PE ratio is actually higher now as compared to back then because the company is currently now under earning because of all the sector headwinds coming at it. So for PoolCorp, this is their guidance for 2025 as well. So management is forecasting around flat to slightly up sales, inflation of 1 to 2%, installed base growing slightly, new construction units flattish, renovation flattish as well. The EPS is projected to be up around 5% this year as well. So this could be the start of an inflection point for PoolCorp. The company has been decreasing in terms of revenue and net income over the past 2 years already. So this could be the start of a new uptrend for this company in terms of its earnings and fundamentals. So for PoolCorp, this is my summary. So it has bad sentiment, it has suppressed earnings, it's a good entry for this name. Buffett buying is a reassurance as well. The company is a strong company with sector headwinds due to macro conditions. And when the interest rates start to fall again, I expect this company to resume back to around 11% growth. It's a small position now that I'm still learning. I'll only add if I'm confident with this one. The company is basically a picks and shovel company in a monopolistic space. And that's why I view this company as a high quality one with an installed base that is recurring as well. So when more pools get built, it leads to a greater installed base, which means more recurring revenue for PoolCorp as well because more people will have to get their pools maintained over time. For PoolCorp, it is a stock that is depressed right now, and that's why you're seeing Warren Buffett buying into it. Next portion, I'll be talking about my cash position. So my cash position is currently at around 30% or so, and the markets are currently at all-time highs. And the markets are expensive right now, they have been for a while. I'm actively looking for stocks elsewhere, and some quality companies are coming up in China as well as Europe. So the first company that I'll be talking about is LVMH. So LVMH is actually down around 30% year to date. It's currently trading at a 17 times earnings. So for LVMH, it's operating in a sector that is hated by people, luxury segment. So all your luxury names, apart from Hermes and Ferrari, they've been on this downtrend for the past 2 years because of the Chinese pullback. So the Chinese consumer is very hard to forecast, but for LVMH, they have a price floor in terms of its assets itself. They own a lot of their real estate in the US as well as in France. And for this company, you basically have a price floor in terms of the assets, the hard assets that a company owns. So it's around half of the market cap in those assets. I'm waiting for this name to drop a bit more. It's basically a Berkshire in the luxury segment. Next company is Multi. So Multi year to date is down around 5%. It's currently trading at a 19 times earnings, giving you around a 3% dividend yield. So for Multi, if you haven't looked at the company before, the company's fundamentals are just incredible. Incredible pricing power, incredible moat, incredible brand. It's a quality business that no one knows outside of China. And for Multi, it's actually one of the highest quality companies that I've seen out there. I'm still reading up on this one, and if the company can provide me with a decent entry in the next few months, I'll likely look to add into this one as well. Last portion, I'll be talking about some questions left in the comment section. So the first one, it says, do you consider McDonald's as a high quality stock? So McDonald's is actually a high quality stock in my opinion. It's extremely predictable, but the problem with the business is it lacks growth. So for all these names, for all these consumer staple names with massive predictability, the only way for you to get a good return on it is to catch them at a good price. McDonald's last year was presenting a decent opportunity at around $245 a share. I hope it gets there soon. Maybe I'll add to it. So for McDonald's, they make a lot of their money from their franchise portion of their business, and they're also sort of like a real estate business as well. So for McDonald's, if you have to look into their operating margin is extremely high, is almost similar to a software company already. And for McDonald's, it's just a predictable company that will keep growing and growing and growing, and it will stay here for a very long time. So there's no worries about this company going out of business or going bust. You will likely be able to protect your capital or even grow your capital over time with McDonald's as an investment. So I view McDonald's as a high quality, predictable business that maybe lacks a bit of growth, but if you can catch it at the right price, this company will give you outsized returns over time. Next comment, it says, what do you think about Duolingo? So for Duolingo, it's a company that's growing rapidly right now. My concern with this stock is I'm not too sure if the company, the app itself, is a cultural moat or if it's just a fad. So there's been a lot of social media apps, Snapchat for example, Vine for example, that have just been a fad, so they come and go very quickly. I'm not too sure about the moat of Duolingo. If the company is a cultural moat, meaning to say if people will continually use this app 5 years, 10 years down the road, then buying it today shouldn't be a problem. But for me, my problem is I don't understand the moat of the business yet. I don't use the app. And the second thing is simply just the valuation itself. It's a high growth company. It is not optimizing for profitability yet. And I don't like adding to stocks that are too early in their phase. I prefer stocks with a strong history of earnings growth so that it is more predictable to forecast their future. For Duolingo, it's a company that is growing rapidly. I'm not too sure about the predictability of the stock. So maybe in a few years' time when a company becomes more predictable, then this could be one to look at. But currently, it's an avoid for me. I hope you guys have found this one useful and invest safe.